Good day and welcome to Phillip Roundtable. Last session, we have delved into Asia's role as a powerhouse that has consistently exhibited strength and adaptability throughout history. In today's session, we'll continue to discuss the economy of Asia for a better planning of our investment. So let me introduce our distinguished panel of experts. Our first panelist, Stanley Tong, is the fund manager of PIMB Investment Management Berhad. He has more than 16 years of experience in equity research and equity investment in UOB OSK Asset Management Berhad and Hong Leong Assurance Berhad. During his career in UOB OSK Asset Management, he oversaw various unit trust funds and investment-linked funds for clients. Currently, he is the designated fund manager for PIMB I Group Fund, PIMB I Flexi Fund, PIMB Arabesque Malaysia Sharia ESG Equity Fund, and PIMB Arabesque Value Cap Malaysia Sharia ESG Equity Fund. Our second panelist, Mike Lai, is a fund manager in RHB Asset Management since 2013. He has 24 years of working experience, of which 19 years are in the investment fields. Prior to joining RHB AM, he was Director of Portfolio Investment in Phillip Asset Management Sdn Bhd for almost 5 years. He started his career in Central Bank of Malaysia after obtaining Bachelor of Accounting from Northern University of Malaysia. Mike was tasked with to manage pension funds and institutional funds for RHB Asset Management. Our final panelist, Kim Cho, is currently an investment specialist at PhillipCapital Malaysia. He has over 5 years experience in the financial industry, mainly in the stockbroking, equity capital market, and investment banking fields, with stint at MIDF Amana Investment Bank Berhad and CAF Equities Sdn Bhd. He has served institutional clients and foreign funds by providing macro research, trading ideas, market commentary, and analysis for Malaysian equities in his previous role as a stockbroker. Kim holds a first-class honours in accounting and finance from University of Warwick, United Kingdom. So without further ado, let us start with our discussion today. So here comes the first questions. With falling energy prices and headline inflation, easing supply bottlenecks, and the reopening of China economy coupled with strong employment and relatively resilient household finances, all of this contribute to the bright prospect. A couple of renowned fund houses, for example Morgan Stanley, are expecting Asia to outperform the West. However, that expectation did not realize as the West, especially the US, continues to outperform the rest of the world. So Kim, how do you see Asia's recovery progress and justify the underperformance?
Okay, thank you so much, Weiler, for the introduction. We still think that Asia recovery is still on track. The reasons why we think Asia is a bright spot this year is mainly, first and foremost, looking from the interest rate perspective. The US Fed and the ECB have been raising their rates very, very aggressively in order to pull down inflation. And this is one of the most aggressive tightening moves in the history. But the rate hike cycle in Asia is more subdued, and Asia's central banks didn't have to raise rates because inflation in Asia has not been as intense as in the developed markets. We also think that Asia is a bright spot this year, mainly because of China recovery. Yes, we agree that China recovery has been bumpy after 3 years of self-imposed isolation, and there's been concern on the demand and the manufacturing side. But we think a modest 5% target by the Chinese government should be attainable. And yes, we agree that there are a lot of noises in the data in the short term, but we think the long-term growth visibility remains solid. We see recently from the PMI data, it has shown that 2 consecutive months of contraction in China. Yeah, inflation number has been lower than market expected. And finally, the high unemployment numbers among the youth. But on the other hand, we see China main retail sales data actually grow 12.7% year over year. If we compare the period between January to May this year, it actually grew by 9.3% year over year. So there have been mix of economic data in China, but we think that over the long term, there should be more and more supportive policies in order to support the sentiments and also attracting foreign investors and fund houses coming back to China again. And do note that we also see the leaders actually have pledged support to boost the economy. And even if we look at PBOC, there has been guiding it will be maintaining ample liquidity in the market, right? In order to stabilize growth, boost job, things like that. And all this will actually bode well for the recovery in China. And also, finally, we think that actually China reopening will actually bring some spillover effect to the rest of the region, rest of the Asia region. And one of the beneficiaries here will be ASEAN countries, including Malaysia. And also, in fact, if you look at IMF forecast, IMF is actually forecasting Asia to contribute around 67% of global growth this year. So this will be mainly led by China and India. So overall, we think ASEAN recovery remains intact. It should be one of the brightest spot, brightest region that investors shouldn't miss this year. Right.
Yeah, thanks, Kim. So I believe this is quite a broad question. So we're happy to hear from Mike and Stanley as well. So Mike, would you like to continue on justifying why the underperformance of Asia recovery versus the West?
Yeah, I mean, I do agree that the main reason is because of the strengthening of the US dollar. Historically, if you look at our market, whenever the US dollar perform well, our Asia equity market actually negative return, you see. But I think if you really look at the index, the Nasdaq, the S&P, and all these things, the thing that undermine this Asia underperformance is mainly because of the AI team. Yeah, if you look at it, it started somewhere in January or February this year. And because of all this AI team that they talk about, and it kind of become a euphoria at the moment, all these like the AI stocks listed in Nasdaq and S&P, they all not only like it has increased, but some have tripled. And you look at NVIDIA, the share price has almost tripled, up almost 300% since the beginning of this year. And then those similar like Oracle, AMD, the share price has also jumped from the low of October 2022 last year. But you don't have this kind of AI team in Asia, you see. Yeah, we don't have that. So that was the main reason why you look at the S&P, the Nasdaq, the index, the points were actually driven by these so-called FANG stocks. Yeah, and some of them are related to AI and things like that. But underlying that, a lot of stocks inside the Nasdaq or even S&P, they didn't actually move that much, So it's the AI team, and we don't have that. I think basically, non-existence in Malaysia, and probably the one that have exposure is basically TSMC in Taiwan, which is actually done well to a certain extent. And of course, because of the AI team, it jack up the rest of the so-called tech firm, but those are not really related to AI, you see. So I think that was the main reason for the outperformance in US, where the Nasdaq up almost 27%. And all these FANG stocks, so-called, your Facebook, your whatever, Alphabet and Google and all these things, their weighting in the index has actually increased. It's about 20%, in the S&P after the euphoria in this AI team. So a lot of this has to do with this the AI. Apart from all those like what Kim mentioned, strengthening of US dollar, the reopening in China are not kicking in and this and that. So just look at ChatGPT. In January, the monthly visit on this ChatGPT is only like, I look at one of the research report, it's only like 260 million, right? But then came June, May, the monthly visit in this ChatGPT has increased to 1.8 billion. Can you imagine the kind of like euphoria that driven by this AI and ChatGPT. So I think that was the main reason. If you want to really want to compare this, the developed market versus the emerging market, I mean, it's hard to explain it when in a developed market you face recession and you face much slower GDP growth compared to Asia, and yet you actually perform so much better than the Asian market. So that will be my comment why this Asian market actually underperformed the developing market. As in, when we recover, I think about time, because the Fed is going to end the monetary tightening quite soon. Yeah, and as what Kim mentioned, our inflationary here is not that it's not sticky. So even the Fed continue to hike rate, we can afford not to hike. Yeah, so I don't think it's that far away. You probably see the recovery in the Asian market very much in the second half of this year. Yeah, so that would be my comment. Yeah, thank you.
All right, thanks, Mike. So Danley, what do you think about this scenario?
Well, I think the main drag for Asian economy is, I would say, mainly China, so to speak. Because for ASEAN countries like us, or even South Korea per se, is pretty close to Chinese economy in that sense. So when they open up in January this year, there's a lot of high hopes that the Chinese economy will conduct a V-shaped kind of rebound. But as we go along the time, you notice that the economy rebound starts to stall in the month of April and May. So that kind of handicap the performance of the countries that is quite.
Sorry, we have some technical problems. How about we proceed to the next question, then we'll look for opinion on the same questions later on. So Kim, we go back to the same questions. So we have justified about the underperformance. So what do you think of the catalyst moving forward so that Asia can get back on track to a better performance?
Honestly, I think we think that actually China government has to try their best to actually fulfill their 5%, so-called 5% GDP target. In fact, if you look at even IMF is actually forecasting around 5.2% growth for China GDP growth this year. World Bank is looking at 5.1%. Even if you look at the consensus number from the Bloomberg itself, is around 5.5%. So they have to come up with a lot of stimulus package in order to support the sentiment per se. Even if you look at PBOC, it has actually cut its benchmark rate by 10 basis points, actually, I think last month. So this will actually provide ample of liquidity to the market. And also during the routine State Council meeting on June 16, chaired by Li Qiang, actually, like I said just now, leaders have been very, very supportive in order to boost the economic growth in China. And actually in the State Council also, they call for stronger measures to enhance development momentum, optimize economic structure, promote sustained economic recovery, things like that. But of course, like what Mike and even Stanley said earlier on, we think that there would be a lot of noises in the data for short term, but the long-term growth visibility remains solid.
All right, thanks, Kim. Mike, what do you think about the catalyst moving forward for Asia?
I think the catalyst, as I mentioned, is that when the Fed stop tightening, and they're about to stop that, and I don't think they will raise the hike very much from here. I mean, the consensus is going for another 2 more hikes. Yeah, but it's towards the end already. So the direction after that will be downwards. So once they stop tightening and the US dollar started to weaken, then I don't think you will see a portfolio outflows, and then people start to look for places where they can actually put their money in terms of get better return country that has better growth and things like that. So that will be the main catalyst.
Okay, thanks, Mike. Hi,
Yeah.
Stanley. Yeah. Can you hear me, Stanley?
Yeah, sorry for the disruption just now.
Yeah, it's okay.
Yeah. Can you hear now?
Yeah, I can. Yeah, would
Okay,
you like
thank
to
you.
continue? We talked a little bit just now, so we can continue now.
It's okay. I follow the flow lah. So you just follow the flow.
Okay, so just now we have talked about the underperformance of the Asia. So what catalyst do you see moving forward so that we can see a better performance on the Asia?
I think actually, in my view, right, the Chinese government will have to do more support for their economy to perform this year in terms of GDP growth lah. The things happening there is that post reopening, I think the business over there is still lingering on the fears of lockdown, so they don't really invest in long term over there. Same goes to the Chinese consumer now. They are also not spending up to the standard that the regulators want to see, so to speak. So you can see that lately, even Korean Airlines is cutting their connection to some of these Chinese cities. So it's pretty bad in that sense in terms of growth and recovery play per se. For Malaysia, we are still waiting for the influx of tourists to come over this part of the world. Usually summer month is the peak month for it. If not, then they will come back to Malaysian market in full force probably by next year, which is also being supported by the commitment of the airlines in Malaysia as well. So I think relying on US to cut rates, that one is uncertain and we don't know when. But on the China side, I do think that there's urgency for them to further stimulate their economy, and hence the Asian economies that is closely linked to them will also follow suit and have a strong rebound later on in that sense.
Okay, thanks, Stanley. So Asia has long been the powerhouse of the semiconductor manufacturing. However, geopolitical issues are heating up. So what are the implications to Asia's semiconductor counters? Mike?
I think this semiconductor issue is, if you look at it, it has changed a lot since the COVID-19 and these are geopolitical concerns in terms of supply chain, you see. And from supply chain issue, it became a national security issue, yeah. So that's why there's now a tech war between the US and China. And of course, the biggest semiconductor chip makers in Asia is in Taiwan. It sits in Taiwan, basically TSMC. Well, all these geopolitical concern, there are positive and negative news from this geopolitical concern. On one hand, because of this tension between China and US, so there are a lot of companies investing in China. They are considering not increasing capex in China, and of course ASEAN and India is the beneficiary because now they look at other countries instead of putting more investment in China because there's a war there. Yeah. So yeah, there are beneficiaries, and Malaysia is one of them basically. I mean, if you talk to a lot of these semiconductor players in Penang and other parts of Malaysia, they receive a lot of calls, to work together to set up a factory here. And you can also see that those industrial parks are actually mushrooming in Malaysia, and property companies are actually selling more industrial park now because there are demand for all these so-called industrial and these businessmen coming into Malaysia to invest, so to speak. That is on the positive part. But on the other hand, because of all this geopolitical tension, a lot of these big boys MNC like Intel, Dell, and all these people, because of all this supply chain issue, they want to bring back all these factory back into the US, right? Because they don't want another situation where, because of COVID and because of the tension, they cannot get enough supply, and it's so costly. Yeah, it disrupt their end product. Yeah, which is why you can see that TSMC put up a US dollar 40 billion capex in Arizona, and they're moving back, instead of outsourcing to Asia, now they're actually doing in-house, right? So there are positive and negative points here, but of course, Asia will be the beneficiaries of this so-called geopolitical concerns lah. But it's expensive if you do it in US, right? All these geopolitical concerns you cause inflation, if you ask me. And look at what happened to the Ukraine-Russia war. Your commodity prices shoot up, your food prices shoot up, and things like that. And this tech war between the US and China, if you bring it back to US, do most of your back-end semiconductor back in US, it's very costly, right? So there are pros and cons there, if you ask me. So it's some will benefit, some will lose out. Yeah. That's my view on this impact on the semiconductor.
Yep, thanks, Mike. So now we focus more on China. The People's Bank of China cut its 7-day reverse repurchase rate by 10 basis points from 2% to 1.9%. How will this influence the borrowing and lending activities in the market? And also recently, China also cut the LPR rate since August in 2022. Is that an indication that China will cut further on the rate? Stanley, what do you think?
I think it depends on the economic data and performance in terms of growth rates in China on a monthly basis. What I mentioned just now is what they are facing, the problem now. Everyone doesn't want to invest in long-term in China. And things like business don't want to take out longer-term business loan. People don't want to buy houses because all this loan is like 5 to 20 years kind of loan, right? So their investment horizon in China these days is pretty short. They are looking at investing only like 1 to 3 years time horizon. So when they reduce the interest rate, will help encourage them to consider making bigger investment in the long run, let's say lah. And over time, the lowering of interest cost servicing also helps the cash flow of businesses in that sense. So I think, based on my assessment, they actually need to do more in that sense, so that people will start spending and investing again in China. I wouldn't be surprised that already now they are more aggressive than US in terms of cutting rates already. So you probably see more of that further down the line before they close this year in that sense. That's my own assessment.
Yeah, thanks, Stanley. So to further expand that questions, there are also, I heard someone saying that because of the high unemployment rate, especially those they're under that's between somewhere around 20 years old, the unemployment rate for the range of people are very high. So do you think this rate cut will really help them because they have no money in the first place? Yeah, Stanley. Yeah, would you like?
Not directly, but indirectly. I would say that when businesses in China start to invest, obviously they need to hire people, right? The problem now is that I think a lot of export-driven plants in China is facing I would say shortage of orders from overseas in that sense. So when they don't have orders in hand, they don't really hire people. Over here is the same. Malaysian companies, when they don't have orders, right, they will just let go the foreign workers. So they will let their contract expiry and not rehiring them. But in China, they don't have foreign workers like us here, right? So any hiring or retrenchment is direct to their population per se. So I think that rate cut doesn't really help them directly, but indirectly, in the long run, they should benefit along the way as business starts to invest in that sense.
All right, thanks, Stanley. So if we move on to a quite interesting questions. So the dollarization was accelerated when the US decided to freeze Russia's foreign currency reserve after Moscow invaded Ukraine in February 2022. And that actually benefited yuan as it has reportedly replaced the US dollar as the most traded currency in Russia. As such, China is also seen prepping its yuan to becoming the next dollar and a global reserve currency by telling its state-owned banks to substantially reduce interest on dollar deposits. So can you argue the possibility that yuan will replace USD? Kim, what do you think about this?
All right. Yeah, the dollarization has been very interesting topic of late. If we look at the statistics over the past 2 decades, there's been a significant decline of negative 19% in the market shares of US dollar. And China yuan actually has experienced noticeable growth, increasing by 3% and attracting attention as an emerging currency. So based on the latest data, US dollar is now accounting for around 58% of total global official reserves, but it is actually down from 73% in 2001. And we think that given China is now the world's second largest economy, and China has gaining a lot dominant position in the global trade right now. Yes, as long as if we continue to see China economy to continue to rise, then it will actually exert more influence in the global financial institutions as well as trade. But we think dollar role as an international currency wouldn't be challenged anytime soon. And also because US dollar, we all know that a lot of countries are using it. It's very liquid. We like US for their well-functioning financial market. So it will take some time to actually challenge that kind of position. But nevertheless, we think when we do our research, IMF data actually, if you look at the direction of trade itself, China was the largest trading partner to 61 countries when we look at the import data, export data. But US was only the largest trading partner to 30 countries as opposed to China. So I think when we explore this de-dollarization topic, right, we should not only focus on yuan itself, we should also look at other regions. And in fact, China is not the only country calling for a shift away from the US dollar. Even I think our Prime Minister Anwar Ibrahim also suggested to set up an Asian monetary fund in order to reduce reliance on the US dollar. I think even in March during the ASEAN meetings in Indonesia, the policymakers also discussed the idea of cutting their reliance on the US dollar. So we have already seen the trend, the dominant position of US dollar is trending lower, but whether or not the position will be challenged, it will take some time.
All right, thanks, Kim. So, Mike, what do you think about these arguable questions?
What Kim said was true. The dollarization is real. It's not something fake that they talk about. And if you look at it lately, a lot of these central banks around the world, they've been buying gold, and they've been shipping gold back to their own country, Also, if you look at it, China, they have also brokered the deal with this Saudi and Iran, and that have kind of reduced the influence of the US, in the market. So I think that the thing is that it intensified at the beginning of this year, somewhere in February, when Russia attacked Ukraine, and then the US actually imposed this economic sanction and policy sanction on Russia, and to the extent they actually frozen their foreign reserve asset. So I think that actually is a wake-up call to the rest of the world. Whether you want to maintain the US dollar, this and that. So because of that, I think a lot of countries start to move away and start to trade with yuan. and then India joined in, Brazil joined in, and things like that. You see, and it become more and more country actually using yuan to trade. Yeah, but it's not that simple. You see, you can't just dump one currency and go for another reserve currency. I mean, imagine it like you use yuan as the foreign reserve currency. How would China behave? You don't know when it became the foreign reserve currency. So I don't think China can match US at the moment on a one-to-one basis. But if you actually gang up together like BRICS, right? Brazil, Russia, India, China, South Africa, then probably you have a more you can actually have more powerful. And then if you link it to the goal, the goal as the underlying, then your currency can be strong and you can probably match it. For China to match US on the one-on-one basis, I think it's tough at the moment. Although they are now the second biggest economy, but to match that, it's a bit tough. I think you need like a BRIC currency or something like that, that are linked to something, to the goal. And then you can probably put it forward to the rest of the world to use it as one of the foreign reserve currency. So I think that's my view on this de-dollarization.
Thank you, Mike. Stanley, we're happy to hear from you on this de-dollarization.
Yeah, actually the de-dollarization trend is more, I would say, beneficiary to China per se. Case in point is that what they have seen, the destruction being done by US on Russia, on all these sanctions is it's like a wake-up call to China. If one day they have conflict with, I don't know, Taiwan Strait, right, and they are being faced by the same sanction as Russia, then the Chinese yuan would definitely be squeezed, and they would need a lot of room for them to survive in that sense by doing away with US dollar. But on the other hand, if you look at from a central bank's perspective, I would think that it's not so favorable to tweak the reserve mix more towards yuan, mainly because it's that usually from time to time we also notice that Chinese central bank do devalue their yuan against the US dollar. So imagine if you are Malaysian central bank and if you hold like a lot of yuan, right, then you worsen your slide in terms of ringgit versus dollar in that sense. So I think offhand I recall, if not mistaken, the yuan's position is less than 5% for most of the central banks. So unless they have confidence that the yuan will not devalue or so, then maybe they can, I mean, like linking to gold is one way, then they can slowly increase the weight in terms of foreign reserve from using yuan rather than dollar. But it's very long-term thing, and in the short run, I think to preserve their own currency strength, I think dollar is still more preferred now. You can see everyone is complaining ringgit these days. So I think our bank governor also doesn't want ringgit to slide further in that sense.
Yeah, just now you talk about ringgit and renminbi. So there's also a recent trend that shows a close correlation between this yuan and Malaysian ringgit. So do you think that trend will continue? Yeah, Stanley.
We have to be in line with the Chinese yuan's trend, so to speak, because our products a lot are going into China. At the same time, we also compete with them on the global arena in terms of orders per se. So the ringgit can't be too strong and outprice itself, you get what I mean? So when the US side comes back to this part of the world, at least ringgit is on par with yuan, then we will not lose our order to the Chinese manufacturers in that sense. If we are too expensive, then we run the risk that you know. From a buyer's point of view, they also want things to be cheap, right? So they might as well give to Chinese plants to manufacture for them. Then Malaysian will lose out. So inevitably, we will have to follow yuan. If you look at Sing dollar is more closer to US dollar, and we are more closer to China per se, because they are also our largest trading partner in this region anyway. So whether like it or not, we will still have to follow that trend in that sense.
All right, thanks, Mike. Sorry, Stanley. So, so sorry. China is also considering a new basket of measures to support the property market after existing policies failed to sustain a revival. While the property sales rebounded in the first quarter, the situation worsened in April and May, dropping below a level seen final quarter of 2022. What do you think of the sector's turnaround, Mike?
I think a lot of optimism is that they expect China to announce something big and comprehensive stimulus, is it? Like before, back in 2016 or back in 2009. But I don't think this will happen this time round. It will be more of a targeted one, like towards the tier 2 or tier 3 city, because those are the ones that are more severely affected. I mean, the land prices in all these tier 2, tier 3 city has dropped. Property prices has also dropped. Sales has been very weak in all these tier 2. So it will be targeted to those tier 2, tier 3 city. I think the dominant issue for this Chinese government is to solve this local government issue, because they have a lot of debt and they cannot sell the land to pay off their debt, you see. So they need to solve this local government issue so that then they are able to pay debt but it's not simple as that, because these so-called Chinese people has, over the last 10 to 20 years, they have leveraged a lot. They bought a lot of properties, and they've been paying back their debt and all these things, you see. And I don't think they want to stimulate those tier one city like Shanghai, Shenzhen, or Beijing, because the prices there are quite high already. So it wouldn't be one big comprehensive stimulus, but it will be targeted to those tier 2 or tier 3 city area. Those will be the one that you can see. So in that case, if that happened, then you won't see a big rebound in all these so-called stock market in China. Yeah, some will help, some may not help, you see. Yeah.
All right, thanks, Mike. So that is all we want to discuss on China. So now we've moved on to India. India has been getting a lot of spotlight recently, as the stock market performance was pretty good over the past decades. India inflation, it cools to 25-month low of 4.25% in May, and the inflation print was 4.7% in April. What are long-term projections for inflation based on the current CPI reading? And how does the CPI reading align with the overall economic growth and stability of the country? Stanley, what do you think about this?
Well, I think these days they already overtake China as the world #1 populated country. So growth prospects on them will remain sound. Low inflation is actually good for them in the sense that they will help preserve the wealth and spending power that is being created by a strong GDP growth performance. If I were them, I would hope that their inflation rate will be kept below 4, I would say, would be better. And if they are looking at GDP growth of 5.5 to 6% per year, then you have quite a good healthy margin in terms of preserving the wealth for their citizens on the GDP growth that they have created in that sense. So it's good news actually for them, where every country in this part of the world is like facing a stubbornly high inflation, right? So yeah, I think it's very good for them.
All right, thanks, Stanley. In 2023, the Organization for Economic Cooperation and Development OECD expects India to grow 6%, China to grow 5.4%, and Indonesia to grow 4.7%, while the global economy grows 2.7%. India is predicted to outshine China as Asia remains a bright spot for global growth, particularly because tech companies are starting to move forward in terms of manufacturing in India. What do you think of this scenario, Kim?
Okay, if we look at India, just to add what Stanley mentioned just now, I think if you look at India's inflation, right, actually, in fact, low inflation is actually benefiting the economy in the sense that the cost pressures where the companies are running are actually much lower. And we actually also see that if you look at the India market itself, right, India has been the foreign investors' favorite this year with net foreign inflows year to date. And foreign investors actually have been buying India because of their very, very strong macroeconomic fundamentals. And even if you look at the insti flows, right, their local instis have also been net buyers in India market year to date. Manufacturing, yes, India is actually the 7th largest recipient in FDI in 2022. And if I can recall, the amount is around 80 over billion. And this amount is actually their highest ever recorded of FDI inflows. So this will actually benefit their manufacturing sectors, particularly the tech hardware, as well as some of the IT services sector. And in fact, if you look at the landscape in India, the demographic has been changing. In fact, also Apple also shifted some of their smartphone assembly operations to India late last year. So there have been a lot FDI inflows coming into India. So your next question to us is probably why is that so? It's mainly because if you look at the government policy itself, they have been investing heavily on the public infra to fuel future growth. There are also various incentives to increase the manufacturing share of GDP, structural reforms, policy support, coupled with low external debt as well as very healthy household balance sheets. This is actually benefiting India. And finally, if we look at the consumption, has been very, very solid. Like what Stanley said, India has emerged to be the most populous country in the world right now. And we are seeing, India, large, young, rising share of upper middle class population will actually benefit India as well, especially their domestic centric sectors. And actually that could probably answer why, if you look at India stock market, is trading near all-time high. In fact, if you look at the valuation also, it's now trading at 19.2 times, quite a rich valuation compared to its peers. But nevertheless, if we continue to see some bright spot in the India economy, then that will actually benefit, like what I say, domestic-centric sectors. It will also benefit some of the financial, industrial, and consumer names within the country itself.
Yeah, thanks, Kim. So there's also one very unique scenario that I observe in India. While the literacy rate in India is low, just 77.7% as opposed to nearly 100% in China, their education is structured in a way that they are very focused on technology, which is why we are seeing a lot of CEOs that are working in Silicon Valley. And there's also a lot of publicly listed companies in the Nifty 50, like the Tata Consultancy, that are very much focused on technology. So, Kim, what do you think of this scenario? And do you think there will be a time that India will probably be on par with Silicon Valley, or probably just a first step to outshine China technology?
I think eventually you have to take some time for that one. If you like what I mentioned earlier, Apple for the first time shifted some of their smartphone assembly operations from China to India last year when Apple released their iPhone 14 and Apple Watch series, basically. So the reason why I think is because I think of India's population, we are seeing like a large group of young and dominant population, and that will actually be benefiting India lah. And also we are seeing some lower labor cost demographic in India itself. And back in China, if you look at the reason why we are seeing some of the production shifted from China to India, I think it's not because China is not good. It's mainly, I think, China is now actually is actually now moving to the upper part of the value chain. So, of course, if you look back at India, the transition will actually take some time. But with the strong support from the government, stimulus coupled with the young demographic in the country, in India, it will actually help to attract some of the FDIs continue to coming into India.
All right, thanks, Kim. So back to home, Malaysia. The Ministry of Investment, Trade and Industry New Industrial Master Plan 2030, also known as NIMP 2030, is being drafted to drive industrial development and advance the nation's economic complexity with the purpose of spurring the next generation of tech innovation companies and developing business opportunities by leveraging new data sources. How do you think this will help the aerospace, chemicals, petrochemicals, the digital economy, electrical and electronics, and pharmaceutical sectors? Yeah, Mike, any comment on this?
I think the new government actually in moving towards the right direction. You can see that our economic minister Rafizi actually came up with some plan, to drive the transform our economy. He basically announced the renewable energy as one of them, and then digital economy, to transform our economy. I think these two we can do it, renewable energy, because we have a lot of sunlight, and then we have a lot of land, and it's something that we can do it quick and fast, short term, and can show it to the public, can show it to the people, and can stimulate the economy in the short term, 1 or 2 year times, something like construction. Yeah. But I think what we need to portray to the world is that what we want to offer as a country. We have missed the window in the past few years. Indonesia has become like to portray themselves as an EV, battery player, simply because they have resources like nickel and things like that. Yeah, and then Malaysia, what we want to tell the world, we have to tell them what we want, you see. And we have missed that, but it's not too late if you ask me. I mean, we do have the competence, the talent, the people. What we need is a good team of cabinet who can work together and draft some good policies, to offer to the world, to come to Malaysia, whether it can be petrochemical. I mean, we have resources, we have oil, we have plantation, things like that. We do have that, and then we have a very good ecosystem of this, all this semiconductor in Penang. So, but we have to tell them what we want to be, so that when they come, this is Malaysia. Whether you want to be a EV vehicles assembly, or whether you want to be a petrochemical hub and things like that, So that, I think we need a very good team of cabinet to draft the policies, and we need continuity for that. So political stability is quite important, if you ask me, for them to, all this FDI to come into Malaysia, So I think that is what we need to tell the world loud and clear, that this is what we want. We're going to offer you this. This is the tax incentive, and you'll be here, and it has to be very transparent, And Indonesia has done that, in the second term of this Jokowi, there are a lot of FDI actually flew into Indonesia during his second term as the as the president of Indonesia. Yeah, so we do have the ingredients, but we have to put in the right policies. We need the right team to implement it. Yeah.
All right, thanks, Mike. Malaysia's retail sales grew more than expected in the first quarter of 2023. According to the Malaysia Retail Industrial Report for June 2023, compiled by the Retail Group Malaysia, the latest quarterly result was 50% higher than the estimate made by the members of Malaysia Retailers Association and the Malaysian Retail Chain Association in March this year of 9.2%. However, Malaysia's retail industry is still facing several major challenges for the second half of the year. So, Kim, why do you think such thing is happening?
If you look at the retail industry, right, basically what happened was actually the disappointing quarterly earnings result. If you can look at some of the consumer names here, they were actually badly hit by higher electricity costs as well as labor costs and volatile input costs as well. Very, very badly hit. So most of the consumer names there actually missed expectation. But on the other side, if we look at the consumer sentiment, it's also coming off actually, mainly because of rising inflation fear. So, and because of the rising cost of living, we are actually seeing some of the spending power among the consumers actually are trending lower. But the good part is that actually there's no immediate plan by the government to actually rationalize subsidy as well as to reintroduce GST. We see actually B40, they are also receiving a lot cash handouts, subsidies, financial assistance by the government. And also, if we look at M40, also their household balance sheet remains very strong, and also healthy job market will actually benefit the M40 growth. So, if you look at the retail sector has been very, very challenging. Although we see there has been some good numbers in the first quarter, but I think we need to be very cautious on the consumer names. But if we can see some return of international tourists, especially those from China, then it could actually benefit the retail sectors like your malls, the fashion retailers, F&B. Those are the examples that will benefit. And in fact, if you look at the pre-COVID numbers in 2019, the Chinese tourists actually account for 12% of the international tourist arrival, but their spending power is much stronger. They actually account for 18% of the tourist receipts. So as long as we can see, more and more China tourists coming back, then probably that will actually benefit the retail sector. But ultimately, I think we need to be very, very selective. Those names that can actually pass on their higher cost to the end customers will eventually benefit. Yep.
Right, thanks, Kim. So moving on to the next questions. The Prime Minister, Datuk Sri Anwar Ibrahim, is touting EPF to invest more in Bursa Malaysia. Stanley, do you think EPF will agree to the request, and what does it mean for Bursa Malaysia?
Okay, I can't really say on behalf of EPF, but I think it's a right move for them to increase investment in Malaysia as well, because we also have a lot of industries here that are serving the global market per se. So of course, growth for Malaysian market this year is not as rosy as previous years, but then again, from a funds flows perspective, whenever there is a vacuum being left by foreigners pulling out of Malaysian stock market, I think the insti side will be a better support for the stock market as a whole compared to retailers. Retailers these days, it's not as hot as in year 2020 when COVID strikes, right? Everyone is like hunting shares these days. But now everyone, I mean, for retail sake, is like struggling to, you know, contain their purchasing power and all that. So we really need the local funds to support the stock market per se, so to speak. It's not doing national surveys, but rather to readjust their mix. Obviously, their foreign weight is quite high already. So by diverting some back into Malaysian shores, I think it kind of makes sense from a government's point of view, right? They are not asking ETF to, totally disband their policy of investing abroad. It's just that the mix has to be adjust if possible and make Malaysia slightly higher weights. So I think it should pan out well. And right now, obviously, they are busy with the six-state election. After they clear the election and they would see what kind of support they have from the rakyat, and then the current administration will continue to drive whatever policy that they intend to do in that sense. So I think that should bring a positive move to Bursa Malaysia as well. You actually need to reverse the downfall to gain back confidence. It's either you reverse it and show people that, look, your stock market is quite okay to invest, then probably the confidence will come back the same. So we will have to try to break away from the vicious cycle of a downtrend in the medium term to regain confidence back from any stakeholders that is invested in the stock market per se.
All right, thanks, Mike. Sorry, thanks, Stanley. So, Mike, for the same questions, what's your view on this?
I mean, the timing is quite okay because our Malaysian market has been the worst performing market year to date. I mean, we are down almost like 7-8%, you see. So, and valuation for a lot of companies has become much more compelling, you see. So, timing-wise, I think putting money into the domestic market is quite okay. But if you look at it on the longer term basis, I think there's something much more need to be done on our stock market. I think the real challenge of our market here is that, the foreigners are not coming in, they're not buying into our market, and they've been being marginalized over the last 10, 20 years. Our weighting in the index is less than 2% compared to back to 1995, 97. That time was more than 10%, and around 10 to 12%. So we had been marginalized over the years. So something needs to be done in terms of all the stocks that are listed in the Bursa. If you look at it, we don't have all these like so-called new economy stocks that are listed in the Bursa. They're sexy enough that people can, they are growth, they are global, they are big enough, where actually foreigner can look at it. Yeah. So just rely on domestic market alone, the earnings of all these companies is quite limited, put it that way. You need more global company, some that can actually invest overseas, and some new economy that you put into the Bursa so that it can attract foreigners to come to buy into Malaysia. As whether EPF should or should not put money, I think they have done very well, EPF, in terms of diversifying into other countries, right? Over the years. And that's why we have been getting very good return from EPF over the past many, many years. Yeah. So, I mean, putting some money into Bursa is okay, but long term, I think they still need to diversify away so that we can get good return from our contribution to EPF. And the rest of the other markets, like around the world, some would have better growth, some would have better return over the years, some have different kind of teams and things like that. So that actually helps a lot to a lot of EPF members in getting good return from EPF, despite, the slowdown in Malaysia or in Asia and things like that. So I still believe that the EPF need to diversify their portfolio, and yeah, that's my answer to that. Yeah.
Sorry, I think Weiler, you're muted.
Oh, I'm sorry, Kim. So, Kim, we have our last questions for you. As several state elections looms, the Malaysian stock market continues cautiously. What are catalysts that can clear the cloud in your point of view?
Agree with what Stanley and Mike pointed out earlier. Yeah, we need to clear this state election and roaming state election. We actually attended a recent call with Merdeka Center. So basically, if we were to compare post GE 14 versus now, the satisfaction towards the unity government are actually going down from around 68% satisfied with the unity government, now around 58%. So the rating has undergone some correction, mainly because I think the current unity government has yet to address the sticky inflation issue, and also they are also losing some of the Malay voters there. Of course, the younger voters, they are actually less negative compared to the older Malay voters. So ultimately, we will need to get more colors from this state election. But of course, our view is that probably we are not likely to see some changes in the state government, likely status quo. And of course, we are also expecting some seat negotiations around the parties, PH as well as BN, but this is unlikely to be a major issue per se. Finally, if we look at Malaysia, I think the economic fundamentals remain very, very solid. I think economists are actually now projecting Malaysia to grow around 4% GDP growth in 2023. Even if we look at the inflation trend has been also slowing down, we still have surplus in the current account, but we need to clear this politics issue. So as long as we can actually continue to convince foreign investors coming in to invest, then our market will actually re-rate.
All right, that is all for our session today. So thanks again, Kim, Stanley, and Mike. And sorry for keep calling the wrong name. So we hope that today's discussion has provided you with valuable insights on planning your investment. Remember to stay informed and proactive in your approach to managing your finances and investments. By implementing the strategies and tactics discussed today, you can position yourself to weather the storm and emerge stronger. Thank you for joining us, and we wish you all the best in navigating through these challenging times. Last but not least, stay invested. Thank you.
Right.
Hey, thank you.
Thank you, everyone. Thank you.